Right now, two of the world's biggest stock markets are at all-time highs. Japan's Nikkei just crossed 70,000, a level it has never seen in 76 years of history. The America's S&P 500 is at 7,440, also an all-time high. And India, the world's fastest-growing major economy, is sitting 9% below its own peak, with billions in foreign money walking out the door. Same planet, same year, completely different stories. By the end of this episode, you'll understand exactly why each market is where it is and what it tells you about how the global financial system actually works. Let's start with the scoreboard. Japan's Nikkei 225 hit an all-time high of 72,831 on June 22, 2026, up 33% this year alone. The America's S&P 500 hit 7,440 on June 29, also an all-time high. India's Nifty 50 peaked at 26,373 in January and has been falling since, now around 9% below that level. Three of the world's most watched markets, three completely different directions. Let's understand each one. Most of the time, global markets move somewhat together. But right now, Japan is significantly outperforming the US, which is itself outperforming India. That divergence is a clue. Something more than just global sentiment is driving each market. To understand it, we need to look at each country's story separately, then bring them together. To appreciate Japan's all-time high, you need to understand what came before it. In December 1989, Japan's Nikkei hit 38,915, the peak of one of the greatest asset bubbles in history. The bubble burst, and for the next 35 years, the Nikkei never reclaimed that level. An entire generation of Japanese investors saw zero net return across 35 years. Japan's all-time high in 2026 isn't just a new record. It's the end of a 35-year wait. So, what changed? The first driver is AI, but not in the way you might expect. U.S. tech giants are spending $800 billion on AI infrastructure in 2026. Japan doesn't build the AI, but it builds the equipment that makes the chips that run the AI. Tokyo Electron, Advantest, Shin-Etsu Chemical, all hitting all-time highs of their own. Think of it as the gold rush analogy. When everyone is digging for gold, sell the shovels. Japan sells the shovels. The second driver is the yen. The Japanese yen has fallen to its lowest level against the dollar in 4 decades, around 160 yen to the dollar. Japan is an export-heavy economy. Toyota, Sony, Honda earn dollars and euros abroad. When those earnings convert back to yen, the profits automatically balloon. Same sales, more yen. It's effectively a free profit upgrade for every major Japanese exporter without selling a single extra unit. The third driver is corporate governance reform, and this one is structural. For decades, Japanese companies held each other's shares in a cozy circle called cross-shareholdings. This protected underperforming management and kept billions locked up, not returned to shareholders. Since 2023, the Tokyo Stock Exchange has been aggressively forcing companies to unwind this. The result? Share buybacks, higher dividends, better capital efficiency, and a genuine re-rating of the whole market. And the fourth driver brought two things together: political clarity and the Buffett signal. In February 2026, Japan's LDP won a landslide election, 316 seats, a party record. Expansionary fiscal policy and government stimulus for strategic industries followed immediately. And Warren Buffett's Berkshire Hathaway took large stakes in Japan's major trading companies. When Buffett buys, global institutional money follows, and it did. Now, the US, same destination, completely different journey. The S&P 500's rally has almost nothing to do with currency effects or 35 years of catching up. It's driven by one thing above all else. AI earnings are real, they are large, and they are growing. Q1 2026, S&P 500 earnings grew 18% year over year, the strongest quarterly growth in a decade. AI is expected to drive roughly 40% of all S&P 500 earnings growth in 2026. Here's the scale of what's happening. Microsoft, Google, Amazon, and Meta alone are spending $754 billion on AI capital expenditure in 2026. That spending flows directly back as revenue and profits for the companies building AI infrastructure. Goldman Sachs forecasts S&P 500 earnings per share of $340 for 2026, 24% annual growth. The U.S. market is at an all-time high because earnings genuinely justify it, at least for now. Now here's the paradox. India's GDP is growing at 6 to 7%, among the fastest of any major economy in the world. And yet, the Nifty 50 hit its all-time high on January 5, 2026, and has been falling since. It touched a 52-week low of 22,182, a drop of nearly 16% from the January peak. The fastest-growing economy, the worst-performing major market. Why? The first headwind is oil. In late 2025 and early 2026, U.S.-Iran tensions escalated and Brent crude spiked from around $69 to a peak near $157 per barrel, more than doubled. India imports approximately 85% of its crude oil, making it one of the most oil-sensitive economies on Earth. Every $10 rise in oil prices adds roughly 40 basis points to India's headline inflation. Higher oil meant higher inflation, wider trade deficit, pressure on the rupee, and a market sell-off. The second headwind is foreign money walking out. Since December 2024, foreign institutional investors have pulled approximately $49 billion out of India. The rupee fell 11% against the dollar, which compounded the pain for foreign investors. A small equity loss became a large dollar loss. FPI ownership of Indian equities fell to a 14-year low. Even when domestic fundamentals are sound, that scale of capital exit creates real selling pressure. The third headwind is earnings. Japan and the U.S. are getting earnings upgrades. India is getting downgrades. India's 2026 and 2027 EPS revisions in dollar terms are minus 14% and minus 15%, the worst among all emerging markets. The IT sector, which is heavily weighted in the Nifty, has been particularly hard hit. Infosys, TCS, and HCL Tech all fell on guidance cuts. A market priced for growth, with earnings being revised down. A difficult combination. But the India story is not all negative, and one data point stands out. Domestic institutional investors bought 78,957 crore of Indian equities in June alone. Monthly SIP inflows have hit a record 32,000 crore per month. Retail India is buying every month, regardless of market levels. This structural domestic buying absorbed the FII selling and prevented a much deeper collapse. The floor held, and that's a genuinely new structural feature of the Indian market that didn't exist 10 years ago. Let's put all three side by side. On year-to-date performance, Japan plus 33%, US plus 15%, India minus 9% from its all-time high. On primary driver, Japan is an AI supply chain play, plus a weak yen. The US is pure AI earnings growth. India has no equivalent tailwind. On currency, the weak yen is a direct tailwind for Japan's exporters. The dollar is broadly neutral for the US. The weak rupee is a headwind. It drives FIIs out. On earnings, Japan and the US are getting upgrades. India is getting the worst downgrades among all emerging markets. On foreign flows, money is flowing into Japan. The US is broadly domestic-driven. India has seen $49 billion walk out since December 2024. Now, here's the thread that connects all three stories. Oil. Japan imports nearly all its energy. Lower oil prices are a direct tailwind. The Iran ceasefire in June was directly positive for Japan. The U.S. benefits from lower oil too. It eases inflation and reduces pressure on the Fed to keep rates high. India is the opposite. Higher oil is the single most damaging macro event possible. It hits inflation, currency, fiscal deficit, and foreign investor sentiment simultaneously. The same Iran ceasefire that sent Japan to an all-time high gave India brief relief, but not enough to reverse the structural pressures already in place. Here's the deeper lesson, and it's the most important thing in this entire episode. Markets don't just reflect an economy's growth rate. They reflect where that economy sits in the global system at that specific moment. Japan is in the AI supply chain. AI spending is a direct tailwind. The U.S. sits at the center of AI earnings. Capex flows back as profit. India sits as an oil importer and IT services exporter. The oil shock and U.S. tech spending uncertainty both hurt at the same time. Same global forces. Three completely different positions. Three completely different outcomes. One honest note before we close. Neither Japan nor the U.S. all-time high is guaranteed to hold. Japan's risk. The Bank of Japan is already hiking rates. A stronger yen directly compresses export profits. The same mechanism that helped Japan on the way up works against it on the way down. The U.S. risk, at 21 times forward earnings, there is no room for an earnings miss. Any deceleration in AI capex spending would be felt immediately. And India actually has a silver lining hidden in the numbers. Valuations are genuinely cheaper today than they were in January, and domestic buying is real. All three markets also benefited from the U.S.-Iran ceasefire. If geopolitics turns again, all three feel it. Let's recap. Japan hit 72,831. AI supply chain demand, plus a 40-year weak yen, plus corporate governance reform, plus the Buffett effect, all converging after 35 years of going nowhere. The U.S. hit 7,440. Real AI earnings, 18% Q1 growth, $754 billion in hyperscaler capex, driving 40% of all S&P 500 profit growth. India at 24,044, 9% below its all-time high. An oil shock, $49 billion in FII outflows, earnings downgrades, and a weak rupee. But domestic investors are building a floor. The same global forces, AI, oil, the US dollar, are hitting all three simultaneously. The direction depends entirely on where each country sits in the system. India's market is cheaper today than it was in January. Foreign investors have pulled out $49 billion, and domestic investors are buying record amounts every single month. History suggests that combination resolves one way, but timing it is the hard part. If this finally made sense of why different markets move in different directions and what it actually means for India, please hit that subscribe button. It's completely free, and it's the single biggest way you help this channel grow and reach more people just starting out. Drop a like so others can find it, and tap the bell so the next episode comes straight to you. See you there.